Welcome to the daily update, where I'll go over the action in the market for Thursday, August 15th. Then we'll see how things look for Friday, August 16th. Had a pretty powerful update. Apparently, the scenario that the economy is falling apart and we're going to go into a recession, even though a lot of folks are clamoring about that, you can probably find all kinds of videos on YouTube and Rumble that talk about how everything's going to fall apart, and it may end up doing that. But for right now, we have switched back to positive. We are positive in the short, intermediate, and long term. We had a really solid update on Thursday. The market really liked the economic reports that came out, and that just brought in a lot of buyers. We're seeing a lot of technical damage that's now either been repaired or in the process of being repaired. In the short term, we are looking a little extreme positive, but at the same time, that can also suggest good momentum. So, where just a few days ago, we were looking more at the negative side. That's why I really stress watching the daily videos, because we've been inching our way over, and now we are looking more positive. We're not reacting to what's already happened. We're just seeing the shift as it was taking place, and now we can take advantage of that. I do have a thing called the SPXInvesting Program. If you want to learn more about that, there are links below this video. And there's also a link that will take you to the website. I post additional videos there. I have some trade ideas and just have more interaction with things that I post there that I don't post here on YouTube. So please feel free to check that out. Also, the daily video is the real foundation of the analysis that I do. We're coming up to the end of the week, so over the weekend I will be preparing the weekly videos, but all of those are meant to tie into the daily video. So let's go back and talk about what happened and then look at some charts. We had a gap higher open. We were kind of flat before the economic reports came out. I had been watching things, and then everything was released and boom, we shot higher. We didn't really see any selling into strength, which is something we always want to pay attention to, but it just didn't happen. So we actually ended up opening above R2 at 54.92, and we got all the way up to R3 at 55.39. And then we were able to hold on to those gains, and we just chopped along R3 pretty much for the rest of the session, and we're able to close right at about R3. We were up 1.61%, but here's the concern. We are still below average with volume. Now, you can explain that away because now the market's looking more positive. Folks aren't watching it as close. They're going on vacation instead of looking at their smartphones and their iPads while they're sitting at the beach. Now they can actually relax and maybe focus on something different. But at the same time, when you look at technical analysis, when you see price really breaking either up or down, you want to check the volume. That tells you the intensity of what's happening. The volume is still quite healthy, but it's been dropping below average. When we were really going down and things were under more pressure, we were seeing above average volume. Now that we're going up, we're seeing below average volume. We just want to be aware of that. We're also coming up now, of course, we're in the middle part of August, but on a seasonal basis, September tends to be weak. We don't know if it's going to be different this time or not, but on a historical basis, it typically has been weak. We also have the Democratic National Convention coming up. That will probably give some kind of boost, at least on the political side. Is the market even going to pay attention to that? So we'll have to see how those things play out as well. We are now looking more positive in the short, intermediate, and long term. A little too positive in the short term doesn't necessarily mean there'll be a pullback, but it doesn't necessarily mean these huge gains are going to continue either. The intermediate term is where we're seeing most of the improvement and has actually switched over to looking positive. We do want to keep an eye on all the geopolitical things that are going on. There's the war between Russia and Ukraine. There's a potential escalation in the Middle East between Iran and Israel. There are U.S. ships steaming over, and they might even be there by now. And then just all the different things that are going on. The Olympics are finally finished, but there's potential for continued unrest in England. So we just want to see if those things bleed through and actually have an impact on the market. All right, some comments. We saw a broad advance after a really strong retail sales report. Now, A month or so ago, this strong report probably would have freaked out the market because good news was taken as bad news. We're still in that process of shifting over from now good news being good news, at least for right now, until it gets too far in one direction. And now it's like, what we did see is there's a 100% chance that the Fed's going to cut rates in September, where it had been about 50-50, that maybe a 25 basis point cut or a 50 basis point cut. It's pretty much shifted back now to the 25 basis point cut. And I'll go over that over the weekend in the weekly video that I do because of this strong retail sales report. And that's such a huge part of the US economy that it means, okay, buyers are not necessarily staying away. They're going out and buying things. And then we had jobless claims come out, and that's not showing that things are falling apart either. But we want to watch that balance between the two, because if things stay strong, that could be inflationary, and then the market could pick up on that and turn more negative for those reasons. We did see interest rates go up and the dollar go up, and a lot of times that will pressure stocks. Didn't seem to have an impact on Thursday. We're back above 5,500 now with the S&P, and the VIX continues to drop. It was above 60 there just a little over a week and a half ago. Now it's all the way down below, I think it's right around 15. We'll look at those charts. And the ADX is cross positive. This was the real thing that I was watching. The two things that I was watching on Thursday was the 50-day moving average. Well, we cleared that right at the open and never came back down to that level. So didn't watch that one as close after the open. The other one that I was watching as the day was unfolding is what's going to happen with the ADX. And we've seen a cross positive now with that. The green line has now come above the red line. So all of the primary indicators that we look at have now switched over to positive. But we want to keep an eye on this. Now, a lot of these are our usual suspects. And anytime we get any kind of an upward move, this list tends to expand. We just want to be aware of these things. If we go back with the rate of change 5 periods, that is looking extreme positive. The Stochc RSI, the Williams percent R, the CCI 14, the 20 is not on the list yet. The stochastics in the short term, the force index, we're hitting that upper Keltner band now, and the boom indicator based on 20 periods. And I'll have charts to show you of all these things. In the intermediate term, a couple of indicators that really we don't see on this list all that often. The CMB composite and the Connors RSI. Even in the long term, we're still dealing with that rate of change going back 200 periods. Now, in a bigger picture sense, this still has more room to run to the upside. The chart that I'm showing is a little bit smaller to kind of whittle it down on even though it's a longer term chart, we're taking a little bit shorter term look at that chart, and we're getting a little extreme with the 200-day simple moving average, which again could also suggest good long-term momentum. And I've changed this a little bit. The Fed has left rates unchanged, but economic concerns are now subsiding. That appears to be what's happening now, where they were having growth concerns. Oh my gosh, we're going to go into a recession. Now they're switching back over to, okay, now the Fed's going to cut rates to stimulate the economy. We like that, and stocks can go up in that kind of an environment. But be aware, we saw a quick switch over to the negative side just 2 weeks ago now. Are we going to be able to stay on this positive side, or are we going to see things switch over back to the negative side? And it does look like they're pretty much anticipating a rate cut in September. The dollar was up and interest rates were up, as I mentioned, and we were getting kind of close up to that 4% level again, but it didn't seem to have an impact on Thursday. We're at 3.93% with the 10-year yield, where we had been at 3.82%. Now, the interest rates going up, that's more because, oh my goodness, the jobless claims were better, retail sales were strong. So the bond market had more of a reaction to that in a way that you might expect by interest rates going up, but stocks just didn't seem to care. We're still inverted with the yield curves. Now, especially with the 10 to the 2, we get close. We get close to the point where we're going back to being normal, but we haven't been able to close at that point, at least yet. Sentiment is still negative. Now we're showing some improvement, so we tend to go with that as it's moving in one direction or the other. We had been at 26, which was just a tick above the extreme negative territory. We're at 33. So we are showing a bounce up there, and we are now positive with our trend. but the ADX still hasn't crossed above its moving average. It's going to take a few days for that to happen. The important part that I look at here is where is the red line, or where are the red lines and green lines? The green line is now crossed back above the moving average, or back above the red line. With the update, our bias is positive and our momentum continues to be positive as well. Okay, this was the big day for economic reports. I don't have charts of all of these, but I'm going to go through some of the numbers here. The Philadelphia Fed index, it was down 7, where last time it was at 13.9. So that's showing some weakness. Retail sales, this is the big one. We came in up a full percent, where they expected it to be up 0.3%. So that was much greater than expected. The last time we had this report, we were down 0.2%. And that's like, oh my gosh, what are we going to do? If you take out autos, we were still up 0.4%, which was double up what they had expected, being up 0.2%, but not quite as much as the 0.5% that we saw last time. The weekly jobless claims came in at 227,000, actually lower than the 232,000 that they had expected. It wasn't really revised all that much from the previous week. Continuing claims did decline as well. So it's showing on a shorter term basis that, all right, the employment situation is holding up and people are going out and buying stuff. So they have jobs and they have money to go buy things. Then import prices, and I don't have charts of this one. They were up 0.1%, where last time they were unchanged. If you take out oil, they were still up 0.1%, less than the 0.2% we saw last time. Export prices were up 0.7%, where last time they were down 0.3%. When you take out agricultural products, they were up 1%. Last time they were down 0.4%. The New York Fed Empire State Manufacturing came in with minus 0.47. Last time it was minus 0.66. So it's still negative, but it's showing some improvement. Capacity utilization, they expected it to come in at 78.6. It came in at 77.8. So that was a little weaker than expected. Last time it was at 78.4. Industrial production came in down 0.6%, where they had expected it to be up 0.1%. Last time it was up 0.3%. Business inventories climbed a little bit greater than expected, being up 0.3%. They expected it to be up 0.2%. Last time it was up 0.5%. The NAHB Housing Market Index came in at 39. They expected it to be at 43, but it's also down from the 41 that we saw last time. All right, here are some charts. Here is the Philadelphia Fed Manufacturing Index, where we've been positive here for most of 2024. Now we're seeing this actually dropping down negative, showing a little bit of weakness in the Philadelphia area. And here's retail sales year over year, the core that we look at, and it's just showing we're actually looking at it's still a decline here, but this is still looking fairly healthy and we're still positive. And the month over month, this is where we saw the big jump, where we were kind of waffling above and below, plus and minus. We saw a real jump up here on this chart. And then production, capacity utilization, where we're going down with production, we're also going down with utilization here as well. And then here's the capacity utilization chart, which is also showing a decrease, and we're below that 80 level. Typically, when we get above 80, that means that everything is running at full capacity. All the factories, everything that's used to do things are being used to their fullest extent at that point. And then here's the month over month industrial production, which actually shows a decline. Here are the weekly jobless claims. We really saw this drop off, showing that not as many people are filing for first-time unemployment. And the moving average is now starting to go down here on this chart. We're still going up with the moving average with continuing claims, but we're declining. But this is starting to come down as well. And the market really liked that. And then here is taking everything together, where we had the unemployment rate, which is up at 4.3. That's when the market really started to freak out about things, that and all the other things that came out in the jobs report. And here's the red line showing a decrease in initial claims and a tapering off to slightly declining here with the continuing claims. And then here's the NAHB Housing Market Index, where we've been seeing things just kind of coming down gradually over time with this particular index that we follow. All right, then this is looking at bearish sentiment, where it had been coming down here. Actually, it's bullish sentiment. I had to move a little thing there. We're showing a pretty low reading overall. And you could look at this again from a sentiment perspective where we were getting kind of negative here. And so as we were really coming down, that could actually give some support to the market. And right now it looks like that seems to be seeing some follow through. And then this is one of those charts. I have to blow up this small area and it's still kind of blurry. The big surge the past 4 days isn't bearish. Well, now we have 5 days because this came out before Thursday session. And what happens when we see a big surge up? What happens after that? Well, 1 month out, we're up a little over half of the time with a pretty decent return. And then 3 months out, 6 months out, and then 12 months out. So strength begets strength in the longer term. Now, we still have September that we're going to have to go through, and we'll have to see how things change. And it actually helps the market to have a lot of the doom and gloomers out there and people that watch all these videos and they're just saying how everything's going to fall apart. That ends up helping the market because we use that as more of a contrarian indicator. But then we have to watch this because when a lot of the videos that are put out there on YouTube and Rumble suddenly become, oh, we're going to the moon. Oh, we're seeing another 20% increase. That's when we become a little bit nervous about things. So we use that in a contrarian manner as well. And then this is actually a bit contrarian as in and of itself. The risk appetite over the next 30 days before we've been seeing the run up, folks were actually more bearish. And so they were trying to avert risk. Well, this ended up not. What we're trying to watch for here is FOMO, the fear of missing out. And that's usually when folks that aren't really involved in the market, they see things going up and they want to rush to buy they're afraid of being left behind. And when we see a lot of that starting to happen, that's when a particular run is usually exhausted at that point. And then near-term outlook, a little bit of a tick up, but most folks, according to this survey, were anticipating a decline. And that also probably helped the market. And then here's the exposure to equities where it has really been falling off, which could also be helping the market as well. Despite the market turmoil, well, now everything seems to be bliss. Inflows into equities continued, so we're still seeing money coming in, but really dropping off of what it had been. And then the VIX around presidential elections. Okay, we're way over here in August. And I'm not sure if this is before or I guess this would be August here. That's next August. So I don't know how useful this is, but usually when we come into September, this is when we see the VIX really starting to go up when there is a presidential election. And then once the election happens, then things tend to calm down a bit. That's kind of the takeaway from this. And then here, 60% expect 4 Fed rate cuts over the next 12 months. Now, and again, anybody you listen to will have an opinion. I look at the probabilities chart and it looks like, yeah, they're anticipating a cut in September. Right now, it looks like at 25 basis points. Going out further than that, I don't do a lot of forecasting. I just look at the charts as they develop. But you still have most of the camp thinking that we're going to get 4 rate cuts over the next year. More, there's even more than that. Now, if everything does shift and we go into a recession or some black swan event happens or we go to war, or anything that we haven't even thought of yet that could be really negative, that could shift the whole scenario. And then here's the 3 cuts, 2 cuts, and so forth. And nobody's expecting a hike or even a change, that there'll be no change. Everybody is expecting some kind of a cut according to this chart. And then the takeaway from this is the forecast that they're showing here, the policy rate declines in most economies over the next 12 months. Just notice how these are both going down right here. That's the takeaway from this. You don't want to read through all these different countries. But really all this is showing is not only in the US, but they're seeing rate cuts coming pretty much globally. All right. And then who's in the most trade right now? Even though it's dropping off to 53%, you still have most folks that are really digging the Magnificent Seven right now. That's the biggest trade. And then another one you can kind of get mixed up here with this chart. 76% say soft landing. And that's kind of the going rate. And I have a chart later to show you that will back that up. 13% think that we'll have a hard landing. This is probably a lot of the perma bears. 8%, we're not even going to land at all. We're just going to keep flying along and not ever come down. Okay, I didn't go through any Yardeni charts. They were pretty much all economic, and the charts that I went through were pretty much the same as what he went through. I found, actually, I did find one interesting chart, but I forgot to post it here on Twitter. It was just informational, more or less here. But here's the intraday chart that we show where we gapped above R2. We got a lot of the gains right at the open, and then we bounced up to R3, and then we're able to stay along R3 for the rest of the day. Looking pretty solid here, seeing a little bit of an uptick in the initial overnight session as we get set to go into Friday. We're still seeing the red line above the blue line. Even though growth is showing some improvement, that's the blue line. It still is not surpassing value at this point, but this is encouraging. Here's the big down day that we saw here, and growth to value was really going down with the S&P intraday, and it's been clawing its way back ever since then. So this is looking better. End of day, growth was up 2.17%. Value was also up, but about half of that. And it was up a little bit more for the mid caps and a little bit less here for the small caps. But you can see all green. And if you're not used to this chart, if you're new to watching these videos, over on the left, these are value ETFs based on their capitalization. Over on the right are growth ETFs based on capitalization. And then in the middle are the basic ETFs. Like this would be the SPY. We would have the MDY and probably the IWM here in the middle. That's what they mean by core. All right, so we're seeing a bit of a tick up here with small cap growth to value, but it's not really breaking out with any gangbusters right now. Also ticking back up, showing some improvement with mid cap growth to value. Seeing a little bit more strength here with S&P growth to value. We want to see this continue to go up to stay more positive. We're seeing some improvement here when we look at our growth versus value ETF. We're coming back up in a little further into the rainbow now. So this is showing some improvement, but to be more positive, we want to be able to break back above the rainbow. Seeing a bit of a tick up here with discretionary to staples, but not anything with real strength. Large cap growth, we were able to get back above the 50-day moving average. So that's encouraging. We had fallen almost down to the 200-day moving average. We were able to get back above the 100. Now we're back above the 50. So that's showing some improvement along the way there. And we're actually ticked down just a little bit. Small caps had a pretty good day because when they see, oh, well, a lot of stores, a lot of places where you go buy things, that's retail sales. And they ended up doing quite well. So we saw this ratio coming down, but overall, large caps have been outperforming small caps. Here is where we're seeing the change for right now. Now, the ADX is still going down. It takes a few days for that to, oh, wait a minute, I'm changing here. I might want to get stronger now. So the trend is still weakening. But the big thing that I'm looking at is the green line has now crossed above the red line. That has switched this over to where we default positive now. And we're seeing that also here with the short-term ADX. So we have the short and intermediate term ADX switching back to positive. But we're still below average with volume. And sentiment coming down, but still quite high here with the ulcer index. And the VIX, well, I mean, like I've been saying, people that don't even know how to spell VIX, suddenly we're talking about it and posting things online, and they have no clue what it actually means, but it was the pop thing of the day when we were having that crash. We're just continuing to come down here, both with the line chart as well as the bar chart. And as the VIX comes down, the VIX of the VIX also continues to decrease. The momentum of the VIX is now down. And maybe we're in this period right now where we do see the VIX coming down, at least on a seasonal basis. So we want to compare what's going on right now with what historically has happened in the past, just to use it as a guide, not to make decisions around that. We did see a decline with the equity put call ratio. Finally, these charts were updated. We're declining with the 5-day, and we're just starting to roll over a little bit here with the 10-day average. And we want to keep an eye on this. This is the spread between risky and not as risky bonds, where we're coming back down a little bit here, but we want to see these lower readings. This is when it was more positive. when this is actually a higher reading because this is an inverted chart, but we want to see this continue to go up on this chart. And we declined with this fear gauge. We also declined with the other fear gauge. So we're seeing lots of confirmation there. We came back up here with the risk on ratio, and that's been showing some improvement as the bigger stocks have been seeing a bit more favor. And we had the latest reading from the American Association of Individual Investors. Now, this is a week ago where they were showing a little bit of an improvement here. They're probably going to skyrocket up and possibly even get extreme positive now, especially if we have a good day on Friday. Volatility risk premium still continues to be quite low. Advanced decline studies, we're breaking out based on price. We're not breaking out based on volume. That's a negative divergence, but we're seeing both of these areas continue to go up, and both of them are above their moving average. So there's some positive and negative on this chart. We're seeing a bit of an expansion of the new highs, really no new lows. We're starting to turn up with the 5-day. We're still declining with the 10-day. This internal measure is showing improvement. We're also positive here with the advanced decline ratio. Both the 19 and the 39 are above zero and going up. So we're now looking positive here with the advanced decline ratio based on price. We're also looking more positive based on volume. And we're turning back positive here with accumulation distribution. Now, again, this is the boom indicator, and it doesn't necessarily give a true reflection of what we're doing in relation to the moving average. This suggests that we're already extreme positive, but you can see down here where we just crossed above a declining moving average, but this is now turned back and is looking more positive. Chaikin money flow coming off an extreme negative reading. The red line's going up, so this is now looking more positive, and the Chaikin oscillator continues to climb, and it is still quite positive. The vortex also, we saw a green cross here above the red. That is also positive. This is another primary indicator. Looking good and breaking out with a cumulative based on price for the S&P, showing an improvement, but still lagging behind based on volume. This is still a little bit more negative for right now, but it may kick into gear. This is a 10-day average of the S&P 500 highs minus the lows, and this continues, ticked up just a little bit, but it is coming down. We watch this because if we can get back above this green line and stay there for a while, that is suggesting broader, stronger momentum. And seeing an improvement here with the cumulative NYSE advanced decline line. And we never really did see a lot of weakness here with the NYSE regular advanced decline line, nor did we see it with this other NYSE advanced decline line. And looking at the common stock, coming back up here, but not breaking out above previous highs, also showing some improvement here based on volume. And the red line, which is the NYSE advanced decline line, is above the S&P. Yes, I know they're on different scales, but you can see over time when the red line is above the bar chart for the S&P, that tends to be more positive for the market. The advanced decline line showing an improvement here, going up with the NYSE common stock, S&P mid caps, and small caps. Short term, where we got above the 50-day moving average. Now, we were just slightly above it after Wednesday. Well, we just totally cleared it, and we're actually a little bit above this pivot point here. So that's looking quite positive for right now. But down at the bottom, you see where we're actually dropping off with volume. We're going up with the 20, 50, and 200 period moving averages and not necessarily extreme yet. We are looking a little extreme. We are getting a bit far away from the 20 period moving average, and that's what the boom indicator here measures on this one. We're showing an improvement here with the distance away from the 50 and also going back up with the distance from the 200. We're still looking rather extreme, even though we're ticking down a bit here with the rate of change based on 5 periods. And if you look at other times, like back in November, where we had a really extreme reading, it just meant we leveled off for a little while before we started going up. We don't know if that's what will happen right now, but this could suggest that we may slow down a bit. And the condition of the 20 period moving average looking much improved. We're actually starting to see the green line turn and go back above the blue line here, and prices above both. So that's actually turning positive. Here is the 20 period moving average. And if we see the blue line cross above the red line, the blue line is the exponential, and that moves faster than the simple moving average. And that would turn the short-term trend back to more positive. The Stochk RSI, again, you can take this two ways, extreme positive or good momentum, because we can show these extreme readings for a long time. Also, just coming and being extreme with the Williams percent R. Also, it can stay this way for a long time. The CCI 14 just barely starting to get extreme net positive, and we're coming up looking positive, but not extreme with the CCI 20. In the short term, the stochastics are extreme positive. We're just underneath being extreme positive in the intermediate term, also turning up and crossing above the midpoint with the long term. So this chart is still looking quite positive. And we went far up here with the force index, enough to hit this upper Keltner band here. So that's a little extreme. And we crossed above the midpoint a couple days ago here. We're up into the +1 channel for our standard deviations chart. That's not necessarily extreme right now. Balance of power above zero and advancing. That's back to positive. This is the CMB composite. We're above this black line, showing an extreme positive reading. The Connors RSI, also an extreme positive reading that we don't see all that often here. And here's the condition of the 50-period moving average, where we're above both of the lines, and now the blue line and the red line are starting to turn up. If we can stay strong and see the red line cross back above the blue line, that would show even more strength. Here is the 50-day moving average, where we had closed right about at a little tick or two above it, the simple moving average on Wednesday. Well, we completely cleared that. The one thing just to keep in mind on here as far as overhead resistance, we came back and we filled this gap and then fell down. Well, we came back and filled these other two gaps here, but kept going up. Are we going to see some kind of previous level act as resistance? Because if we keep going up, we're not all that far away from the all-time high. And we're above all the plotted moving averages now. The longer we can stay up here, the more these lines will turn up. We want to see the 20s cross back above the 50s. And we're kind of brown right now with the go, no-go system. That's more of a neutral reading, even though we have clearly been going up. And we're above the midpoint and coming close to the highest high line here. That's the blue line. That's showing a real improvement there. And we cleared back above all these anchored moving averages. And the TTM squeeze showing improvement. Still slightly negative, but another day or so with good momentum, and we could actually cross above the midpoint and turn blue. Standard deviation still showing that we're moving rather fast with stock prices. The ease of movement is still negative, but could potentially cross positive pretty quick here. The Erin indicator, it's on vacation. It's out at the beach, not really paying attention. And we're looking pretty solid here with the S&P McClellan oscillator. We're above zero and advancing and not necessarily extreme. So we're going back up with the summation index based on price and volume. NYSE McClellan oscillator also above zero and advancing. So we're going back up with the summation index based on price and volume with the NYSE. Swenlin trading oscillator, both price and volume are above zero and advancing. Turning back up, but not quite positive yet with our PMO. We're starting to cross back over based on price and volume down here. So we're seeing a real improvement with the PMOs that are rising. The buy signals are going up, and we're starting to turn up with the PMOs above zero. We are positive with the Elder's Impulse system with the green bars. We're positive with the parabolic SAR. We've had a second day now with the dot underneath. We're turning back up and looking positive with the slope oscillator. We're above the moving average, getting back up above this red line. It will really turn positive if we get back up to the zero level here. So it's just showing improvement, but since we're above the moving average, I still call that positive. MACD crossing back above its moving average, but we're still below zero. So it won't be full-blown positive until we cross back above zero. So in the short and intermediate term, we are turning back up and turning positive on a momentum basis. Long term, with the tricks in KST, starting to turn up, but have not crossed above the moving averages yet. Copy curve is positive now, and we're getting positive. We're getting up into this green area here with the Sean trend meter. The BPI, bullish percent index, continues to advance. That's just showing more buy signals inside of the S&P 500 that are being triggered. And so this is a good internal measure, and that's positive. And we're turning back up, going back above 50, looking more positive with the NYSE bullish percent index, also showing some strength here with the NASDAQ 100 bullish percent index. And this is what we see as we're going back to the scenario that was happening before, that the economy is not falling apart, that the Fed's going to cut rates to stimulate the economy. When this really started to go down, that was when folks were concerned about going into a recession. And at least as of right now, now that could all change at any time, but folks are not seeing recessionary pressures on the horizon. We're above 50 and still going up with the money flow. We're also going up with the ultimate oscillator. On balance volume continues to advance. The RSI 14 and 9 are above 50 again, showing much improvement there. The stocks above their 20-period moving averages, above 50 and going up. That's showing an improvement. So we're looking a little bit better with our study. When we show more real strength is when we get above this dashed line. That means we get above 70 with this reading. We're looking better with the 50-period moving averages, the 100, and the 200. Now, this is one we're just kind of keeping an eye on. We're finally starting to roll over here with the mass index. There are three triggers that we need to see here. Once we go above the red dash line, that's one. Two is when we go above the blue line. Three is when we come back down and cross back below the red dash line. This is anticipating a reversal at that point. And we just have to wait until that happens to see what kind of context we're dealing with. Support and resistance levels. We finally were able to break out above the mini rainbow with our 20-period moving average study here. The longer we can stay above this, the more these lines will start to turn back up. And we're still negative here. The blue line is still below the red line, but we're starting to break out of the cloud here, and the green line continues to go up with our Ichimoku study. And we're coming back up. We're able to get back above this 50% fib extension level again here. This is also positive. This is a weekly chart of the S&P, and we're above this R2 level. We were able to get above that. Now, we still have 1 day to go, and this is a weekly chart. If we can close above this after Friday, that would still keep things more positive longer term. And we're switching back to looking positive with our trend here, with the Heiken Ashi being positive, the Kagi chart is positive, the Renko chart is positive, and the three-line break is positive. And we had just enough of an up move to generate a new X after working off of our low pole reversal here. And then we're showing some improvement with the 150 moving average study, but we're starting to break above the red line here with the 200. Again, two ways to look at that. Ooh, extreme, we better watch out. Or this is just showing that we're having good momentum longer term. Here's the shorter look at the rate of change going back 200 periods. We're well above this blue line now. That, on a shorter term basis, even though it's a long-term chart, could still just something we want to be aware of here. We are positive across the board with the Keller market model. All time frames on all indexes. Still negative with commodities and the dollar across the board. Everything else is switching back to positive. All kinds of blue and green. No Christmas going on here. We're just seeing one color along the way with the NASDAQ doing well. We had the MACD crossover here with the S&P. We're well above 5,500 here with the S&P, and a lot of positive things happened technically on Thursday. All of the sectors were up except for real estate, because interest rates are going back up now if there's more economic strength. But we saw discretionary and tech leading the way higher. Those are growth areas. And we're looking good here with the equal weight. It's still above the weighted S&P 500 index. We're going back up as the mega caps are doing quite well now, or at least a little bit better on a relative basis. So this just means that the bigger stocks are leading the way back up. We're looking better here with the new highs minus the new lows on the NYSE. We're back above zero. And we were able to get above this pivot point with the Dow. So that's been showing some improvement, and it's getting close to its recent all-time highs, but still not there yet. We are positive with the Elder's Impulse system for the diamonds. Now, this is kind of interesting. We came up to the 50-day moving average with the NASDAQ. Could that still be providing overhead resistance? Also, a little bit above it here with the NASDAQ 100 and right underneath this pivot point. Will this produce some kind of overhead resistance here when you combine those two together? But we're positive on a trend basis with the Elder's Impulse system for the Qs. We're turning back and looking positive with the PPO. Now, we're not full-blown positive until we get above zero, but the fact that we're above the moving average is really helping this to show an improvement. The Qs were able to close just barely above their 50-day moving average, showing some improvement here. If we can continue to go up, and eventually see the blue line come back above the red line, that will turn things more positive even still. And we were able to get back above this 23.6% fib extension level after losing that. The small caps had a pretty good day, but we're still range bound. We're not really breaking out all that much here. We're just coming into the higher end of this range. We've been at these prices before. We want to see if this can still continue, but they're showing some improvement. And we are positive with the Elder's Impulse system for the small caps, crossing above when we look at the Russell 2000 small caps, going above 50 now with the RSI. We're above the 50-day moving average. The momentum is still negative, but trying to turn up. Mid caps, we're finally able to get above their 50-day moving average. So that's showing some improvement, but we're still below this pivot point. And we are positive with the Elder's Impulse system for the mid caps. Finally able to get back above the 50-day moving average with the Wilshire. This is a broad market measure that we look at, and this is rather encouraging. And we're also getting above, this is the biggest thing that I know of. It's 2,651 stocks. We had been coming back up to the 50-day moving average. Well, now we were able to clear that. That is a broader market measure as well and showing much improvement. The FANG index, is this going to be? See how the NASDAQ 100 and the FANG index are kind of bumping into their 50-day moving averages? It will really help things if we can get above this and then close above it. Well, we'd like it to happen on Friday, but at some point anyway. And we are coming back up to this other trend line here, going from these lows. We broke out above these previous lows. That held as support eventually. The shorter term trend line, we're starting to come back above it. So that's showing some improvement there as well. Financial sector still looking good and breaking out above their 50-day moving average, and that's encouraging. The staples to tech ratio is going down. That means the tech sector is outperforming staples. Small caps coming down when compared to tech. When this is going down, that means that tech is outperforming. And Apple was up 1.33% above their 50-day moving average. Up over 4% was Amazon, finally able to stay above its 200-day moving average. Microsoft above its 200-day moving average, up 1%. Meta is looking a little stronger now, up a little bit more than 2%. Google was up just 0.58%. There's news coming out that they may try to break up Google. They did the same thing to Microsoft. They did the same thing to AT&T back in, the 70s or 80s, whenever that was. And that could be putting some pressure on Google. Way back in the late 90s when this is going on with Microsoft, this is when I was actually teaching the Microsoft certified courses and involved in the market at the same time. And Microsoft just went sideways for quite a while. And then they ended up breaking it up, at least on paper. Is something like that going to end up happening with Google? Just something that we'll be following. NVIDIA finally able to get back above its 50-day moving average. Hasn't seen this low a level since yesterday. Yeah. Tesla also was up over 6%, 6.33%, trying to get above its 50-day moving average. Netflix putting out some good movies right now, I guess, up 0.25% above their 50-day moving average. So the broad market here, still looking negative. Still getting a minus reading here, but this is showing some improvement with the 5-day moving average of the highs minus the lows. When we look at U.S. versus international stocks, the short-term and even the longer-term correlations still are pretty strong. And the dollar's still in an uptrend here, but we've been really coming down. We did tick up on Thursday, but this has been showing some weakness overall. We want to keep an eye on oil just in case things really start to escalate there in the Middle East between Iran and Israel. And we went up with the 10-year yield. We were down with the 10-year based on price, but the market didn't seem to care. Now, just looking at some bond versus stock prices, and then I'll go over this again in the weekend videos and various videos that I show. We're coming down here with this ratio, and that means that stocks are outperforming bonds now. And looking at the S&P 1500 compared to short-term bonds, we're starting to break out above the rainbow. The other broad market measure with further out bonds, we're just coming up back into the top of the rainbow. The tech sector also coming back up, but still in the rainbow when compared to 3 to 7 year bonds. And we're coming back up now because if we're going back to that other scenario, folks may get out of government bonds and jump back over into junk bonds. And we're seeing a little bit of a tick up with this ratio. This is the soft landing versus hard landing. When we're up in soft landing territory, which we're starting to go back up into, that means the market is not anticipating a recession. If we come all the way down here, see how we were falling when the market was like, oh no, we're going into a recession. Well, it didn't seem to last very long here. We're switching back to the other scenario. And then we're seeing some improvement here with the growth to value ratios. Q's to S&P coming up, it's still declining. Okay, still going up, it's still below a declining moving average with discretionary to the S&P. A little bit above the moving average here when we compare large cap growth to large cap value. So the large caps, mid caps, and small caps are improving, but we're still seeing these moving averages going down. Ticking back up here with the S&P to utilities ratio. When this is going up, that's more positive for the S&P. This is coming down with the staples to S&P ratio. That's more positive for the S&P. So what's our outlook? We're positive, but we're becoming short-term overbought or extreme positive or showing good momentum, however you want to interpret that. We're going to get housing starts and building permits as well as consumer sentiment on Friday, and then all the different crazy things going on in the world if they have an impact on the market. And then we still have 1 day left of our economic calendar here. Nothing left on this economic calendar. Seasonally, we're neutral to positive. Excuse me, with the Dow and NASDAQ, where we're just flat out positive with the S&P on a seasonal basis. This is going to be options expiration on Friday. So that can make it kind of a crazy day as well. And typically it will see a high volume day. And Friday is the second most positive day of the week based on what happened in 2023. And so this is options expiration. We do see some positive seasonality here during an election year. And just wondering where we're at with all of this. We're now starting to go back up here, which is what we have historically seen when you compare it to 1968. And then we also tend to see positive seasonality here, even if the current president is not running for re-election. But September, we just want to keep that in the back of our mind, because at some point September is actually going to get here. So both of these charts on a seasonal basis just show that September tends to be weak. It could be different this time, but we also want to pay attention to historical norms. And this is taking August to October, which this 3-month period of time, let's see, August, September, yeah, 3-month period of time tends to be negative overall. Sometimes October and August are okay. It's September that tends to wipe out the gains. And we're positive in August on a seasonal basis, no matter how you measure it, but we're negative in September, no matter how you measure it. So our warning signs, we want to keep an eye on these defensive sectors like staples, utilities, and healthcare, and we're keeping an eye on energy as well. The growth to value, yeah, they're improving, but we want to see more improvement. We want to see more follow through than what we've seen to this point. And if there is more follow through, that could suggest further gains for the S&P 500. The ease of movement is still negative, but improving. It could possibly cross back over positive. We have a pretty long list now on the positive side. We have the equity put call ratio, the 5 and 10-day charts are going down, and our 3 smart money indicators are positive now. And the advanced decline lines, they're doing quite well. The McClellan oscillators and summation indexes for the S&P and NYSE are positive. The Swenlin trading oscillator is positive. The parabolic SAR, our oscillators in the short and intermediate term, are turning positive. We're rolling over a bit and looking better in the long term, but they're not quite above their moving averages yet. The bullish percent indexes for the S&P, NASDAQ 100, and the NYSE are positive. Money flow is positive. Ultimate oscillator, the Copic curve, the vortex is positive, and the financial sector is now showing continued strength as it has been. And the momentum for the NASDAQ 100 is now positive. So our conclusion, we're positive overall. In the short term, we're looking a little extreme, not a real surprise there. In the intermediate term, we're just flat out positive. Now, there's some of our indicators that are still negative and haven't quite crossed over to being positive yet, but when you take it all together, we can pretty much reach a positive conclusion now, and we continue to be positive in the long term. So thank you. I really hope you have a great day on Friday, and I will talk to you in the next video.